Welcome to the Daily Stock Beaver Market Briefing. Today is July 13, 2026, and we're going to dive straight into the market snapshot. The U.S. reinstated a naval blockade on the Strait of Hormuz with a 20% cargo transit fee, and crude oil surged 9.4% to $78.14. The Nasdaq fell 1.55% as semiconductors sold off sharply. Bitcoin dropped through $60,000 before stabilizing near $62,100, and the S&P 500 slipped 0.79%. Let's break it all down. The story driving today's session is the Strait of Hormuz. President Trump announced a naval blockade on the critical shipping lane with a 20% cargo transit fee, and ship traffic through the choke point collapsed by roughly 60% from the prior week. Crude oil jumped about 9%, and the energy sector was the standout gainer, up nearly 3%. The second shock hit semiconductors. SK Hynix debuted on Nasdaq on July 10 after raising $28.1 billion, but enthusiasm faded fast. The stock and Samsung both sold off, dragging South Korea's Kospi down 9%. US-listed chip stocks followed, with the semiconductor sector down nearly 5%. Third, Fed Governor Christopher Waller warned that rate hikes may be imminent if inflation disappoints. The FedWatch tool now prices a 46.5% chance of a July rate hike. We'll dig deeper into the Fed's policy path later in the show, and coming up next, we'll break down why gold and silver both fell today despite the geopolitical tension. Here's the pattern across every asset class. Stocks down, oil up 9%, gold down 2.6%, Bitcoin down 3%. This is a textbook geopolitical risk-off session, but with a wrinkle. Normally gold catches a bid when Middle East tensions escalate. Today it didn't. That divergence tells you the market is pricing higher interest rates as the bigger threat to asset prices. Let's run the board. The S&P 500 closed at about 7516, down 0.79%. The Nasdaq fell 1.55% to roughly 25,900. The Dow held up best, down just 0.26% to about 52,500. The Russell 2000 dropped 0.83% to 2953. The VIX Fear Index sits at 17.16, elevated but far from panic territory. The overall market regime is neutral. On the indicators, long bonds fell with TLT down 0.59%. The 10-year Treasury yield sits at 4.56%, up 2 basis points today. The national debt stands at about $39.4 trillion, and we'll dive deep into the federal budget later in the podcast. Gold dropped 2.6% to about $4,006. Silver fell 3.6% to $57.97, and we'll go much deeper on precious metals coming up next. Oil surged 9.4% to $78.14, and Bitcoin fell 3.1% to about $62,100. 7 sectors green, 7 red, and the split tells you exactly what's happening. Energy is the clear leader, up 2.99%. That Hormuz oil spike is flowing straight into energy stocks. Behind it, utilities, financials, real estate, and consumer staples all posted modest gains of 0.5% or better. That's a classic defensive rotation into sectors that don't depend on economic growth. The damage is concentrated where you'd expect. Semiconductors got hit hardest, down 4.77%. Technology followed, down 2.12%. International stocks ex-US fell 1.83% as a stronger dollar and trade risks weighed. Industrials and materials both dipped just under 1%. The pattern confirms what we saw across asset classes. Money is rotating out of growth and into defensives and energy, driven by a geopolitical shock and Fed tightening fears. The question for the rest of the week is whether Tuesday's bank earnings can shift the narrative. JP Morgan, Goldman Sachs, Bank of America, and Wells Fargo all report, with Wall Street expecting nearly $39 billion in trading revenue across the major banks. Whether those numbers can offset the Hormuz headwind is the question. Now let's zoom out and see how the week has shaped up. Week in review. The week of July 6 through July 13 delivered a genuine geopolitical risk-off rotation, arriving just as the year-to-date narrative was showing signs of fatigue. The Russell 2000 dropped 1.87%, small caps taking the brunt of the risk-off pressure because they carry more debt and less pricing power when input costs spike. The Dow fell 1.5%. But here's the divergence worth noting. The Russell is still up 17.74% year-to-date, actually outpacing the S&P's 9.58%. So this week's pullback doesn't erase months of gains, it marks a shift in tone, not a trend break. The sector rotation tells the real story. Energy surged 6.66% this week, extending its YTD gain to 24.48%. That's the Hormuz effect. Oil prices spiked on the Strait of Hormuz blockade, and energy stocks moved in lockstep with the commodity. On the flip side, semiconductors, still the best-performing sector on the year at plus 76.48%, got hit for a 4.8% weekly decline. When your YTD leader starts pulling back sharply, that's an exhaustion signal worth watching. It tells you the smart money is taking profits where gains are deepest and rotating into defensives. And that defensive rotation is unmistakable underneath the headlines. Utilities, consumer staples, real estate, all green. These are sectors people buy when they're protecting capital, not chasing growth. Meanwhile, industrials dropped 3.26%, partly on Delta's Q2 earnings call, which underscored cost pressures from rising fuel. When airline margins get squeezed by oil, that signal ripples through every transport and logistics name. Not a panic, but 9 sectors finished red and only 5 green. The market's internal temperature is cooling, even if the index-level damage looks modest. The cross-asset picture contains one genuinely surprising divergence that defines the week. Crude oil surged nearly 11%, up 35.5% year-to-date on the Hormuz blockade. The dollar strengthened modestly, up 0.3%. Those two moves make sense together. Oil shock plus safe haven demand both push capital toward the greenback. But here's what doesn't fit the traditional crisis playbook. Gold fell 3.65% this week and is down 8.69% year-to-date. Silver is down over 20% YTD. In a normal Middle East escalation, you'd expect gold to catch a bid, but it didn't. That tells you the market fears higher interest rates more than geopolitical risk. When Fed Governor Waller warns about potential rate hikes on the same week oil surges, gold becomes the casualty, because higher rates raise the opportunity cost of holding a non-yielding asset. Bitcoin barely moved at minus 0.16% on the week, but its 30% YTD decline tells you crypto isn't functioning as the inflation hedge its advocates promised. Long bonds fell 0.84%. The 30-year is now down 3.78% YTD, and when bonds and gold fall together, that's not a risk-off trade. That's an inflation fear trade. The verdict: oil up, gold down, rates rising, dollar firm. That's the market betting on inflation and higher rates, not a traditional fear trade. Watch bank earnings this week. JP Morgan, Goldman, Bank of America, and Wells Fargo all report Tuesday. Whether their numbers can offset the Hormuz headwinds is the key question. Now let's get into the commodities deep dive, starting with energy. Commodities. The dominant commodity story is a supply shock colliding with the threat of higher interest rates, creating one of the most bifurcated commodity markets in years. Heating oil is up 75.9% year-to-date. Gasoline futures up 75.2%. Those aren't just numbers. They're the reason your fill-up costs more and your heating bill will sting this winter. Crude oil up 36.3% rounds out the energy shock. Meanwhile, gold is down 7.5% and silver down nearly 19%. Energy is repricing a real physical disruption. Precious metals are being punished by the rate threat. Same economy, opposite signals, and that split is the entire story. The energy story is the Strait of Hormuz, full stop. WTI crude surged 14% this week to $78.14 per barrel, and Brent jumped 15.6% to $83.24. Ship traffic through the strait collapsed about 60% from the prior week. Only 14 vessels transited on July 12. This isn't speculation, it's physical supply being choked off. U.S. crude inventories excluding the SPR drew 6.2 million barrels, a 1.9% decline, right as we enter peak driving season. Both crude and gasoline draws outpace seasonal norms, meaning the market was already tight before Hormuz. Meanwhile, natural gas fell 10.7% on cooler weather forecasts. The two energy markets are telling completely different stories, which confirms this is a geopolitical oil premium, not a broad commodity demand surge. The EIA dashboard makes the seasonal comparison stark. Crude stocks at 319.5 million barrels and gasoline at 212.1 million are both running below typical levels for early July. That tightness matters because it means there's no buffer if Hormuz stays disrupted. The system enters the disruption already lean. Natural gas storage built normally to about 2983 BCF, consistent with the gas market's separate, softer trajectory. Oil and gas have completely decoupled. Our smart money analysis reveals a fascinating split. Big traders in WTI crude are surprisingly cautious, only 7.28% long, at just the 14th percentile of the last 6 years. Despite the supply shock, hedge funds and CTAs are not piling in. That tells you they think the Hormuz premium could evaporate with a diplomatic resolution. But here's the real tell. Oil producers are hedging at the first percentile, among the lowest levels in 6 years. The companies that actually pump the oil are leaving exposure unhedged because they believe prices are heading higher. When the people who know the business best are that confident, it's a powerful signal. Gasoline is a different beast. Big traders are at the 27% long mark, and positioning is near the most crowded in our entire dataset. If the Strait reopens, that crowded gasoline long unwinds fast. The precious metal story is about what gold isn't doing. Gold fell 3.6% this week to about $4,006 per ounce, down 7.5% year-to-date. Silver dropped 6.7% to $57.77, now down nearly 19% on the year. This despite a Middle East crisis that would normally send safe haven demand soaring. The explanation is rate expectations. When the Fed openly discusses hikes, the opportunity cost of holding non-yielding gold overwhelms the geopolitical bid. Copper, the industrial metal, actually rose 1.7%, the one bright spot, suggesting some investors still believe in industrial demand despite everything else. That divergence between copper rising and gold falling is the market saying, we believe in growth, but we're terrified of rates. Big traders still hold a meaningful gold position, 26.6% long at the 86th percentile, but velocity turned slightly negative, a sign of modest profit-taking. Gold producers are hedging at just the 4th percentile, barely locking in any forward protection. That's notable. When producers aren't hedging at these levels, they either expect prices to recover or they're too focused on operations to bother. Either way, there's no producer hedge wall overhead. The risk is on the speculative side. If the geopolitical premium fades and the Fed holds pat, that 86th percentile long becomes a crowded exit. Palladium is our highest-risk metals position. Big traders are heavily short, and any supply disruption could force a sharp reversal. For your grocery bill, the signals lean higher. Corn futures are up 10% over the past month. Wheat has surged 29% year-to-date. Coffee pulled back 5.6% this week, but has still jumped 30% over the past month. Remember, these are wholesale futures prices. The impact on store prices lags by weeks and is typically smaller, but the direction matters. When grains and coffee move together to the upside, food inflation is rebuilding just as the Fed is debating whether to hike again. The most dramatic shift in our entire dataset is in corn. Big traders added nearly 59,000 contracts in a single week, the largest position change across everything we track, flipping from bearish to bullish. When speculative money pivots that hard, that fast, it usually means a fundamental supply story is breaking. Coffee producers are carrying essentially zero forward protection, hedging at the 0.2nd percentile. They're so confident prices will hold that they're not buying insurance. Live cattle at the 88th percentile long with negative velocity looks like a crowded trade beginning to unwind, which could mean lower cattle futures ahead. Now let's see how the dollar is holding up against the world's major currencies. Currencies. The dollar has been strengthening against most major currencies this year, and this week's Hormuz shock only reinforced the trend. The euro has weakened 3.2% against the dollar year-to-date. The Japanese yen is down 3.6% YTD, trading at 162.4, approaching levels last seen in 1986. The yen story is the most dramatic. USD JPY within range of 165, a 40-year extreme, as the Bank of Japan remains the holdout among major central banks. When a currency hits multi-decade extremes, you're not just looking at a trade, you're looking at potential intervention risk, because governments don't sit idly by at those levels. The Canadian dollar bucked the trend this week, actually gaining strength as the oil surge benefits a major energy exporter. That correlation, oil up, loonie up, is textbook commodity currency behavior and confirms the move is real. Two emerging market stories stand out. The Korean won strengthened 2% against the dollar this week, but that follows a 9% Kospi crash tied to the SK Hynix debut. The won's move reflects positioning adjustments, not economic strength. The Chinese yuan has strengthened 3.2% year-to-date, one of the few currencies outperforming the dollar, which signals Beijing's capital controls are doing their job even as the rest of the world's currencies slide. The Turkish lira continues its structural decline, down 9.3% YTD, a reminder that some currencies reflect policy failure, not market dynamics. Our smart money analysis shows hedge funds were positioned short the dollar as of July 7 before the Hormuz escalation hit. Euro shorts sit at the 97th percentile, an extreme bet on further weakness. But institutional investors, the pension funds, disagree, holding the euro net long at 55.5%. That's a stark split. Fast money is betting the euro crumbles, long-term money is betting it holds. When those two groups disagree this sharply, a single headline can force one side to capitulate, and the resulting move is violent. In the yen, Positioning sits at extremes on both sides, meaning any policy surprise from either the Fed or the Bank of Japan forces everyone to adjust simultaneously. For listeners, the stronger dollar means your money goes further in Europe or Japan this summer. The downside, U.S. exporters face a headwind, and international stock returns shrink when converted back to dollars. Bottom line, the dollar's strength reflects the Fed's hawkish stance and the geopolitical safe haven bid. Both forces look set to persist. Treasury and Rates. The yield curve is telling a story of growth and inflation anxiety, not recession. The 10-year Treasury sits at 4.56%, up 7 basis points on the week. The 2-year is at 4.21%, the sharpest move on the curve. The 10-year minus 2-year spread is a positive 0.35, and the curve is not inverted. That matters enormously. An inverted curve has been the classic recession warning, and right now the market is pricing the opposite, growth continuing, but with inflation that may force the Fed's hand. For real people, this cuts both ways. If you're a saver, a 4.21% 2-year Treasury means CDs and money markets are paying real income on the safe portion of your nest egg. But the 30-year at 5.6% signals mortgage and auto loan rates stay elevated. The 2-year's weekly rise directly reflects Governor Waller's warning that a July rate hike is on the table. The bond market is taking that threat seriously. FINRA data shows Treasury trading volume hit about $804 billion on July 10, with a 48% dealer customer share. That proportion matters because it means real money investors, pension funds, asset managers, are actively repositioning, not just banks trading among themselves. When institutions are moving that aggressively, it confirms the rate shift story isn't just trader noise. Here's where danger concentrates. Hedge funds are massively short across the Treasury curve. The 2-year sits at 45.8% short, our highest risk financial contract. The 5-year at 39.3% and the 10-year at 37.3% reinforce that this isn't an isolated bet. These are direct wagers that rates keep climbing. On the other side, pension funds are net long about 60% in the 5-year and 54% in the 2-year. The 2-year is the highest probability squeeze candidate in global markets. If inflation comes in cooler or the Fed holds pat, those shorts must cover simultaneously, and the rush for the exit becomes the trade. Stock positioning reinforces the defensive picture. Hedge funds are net short the S&P 500 at the 75th percentile, a bearish bet that's been building. The VIX is the single most extreme reading in our entire dataset. Leveraged funds are 23% long at the 99.8th percentile, a level our system has not seen in 6 years of data. Professional money is buying volatility protection at extraordinary levels, which is either prescient insurance or a crowded contrarian signal. Bitcoin futures show leveraged shorts at 58.4%, another high-risk crowded bet on risk assets breaking. The cross-asset picture is stark. Across every category, smart money has converged on one coherent narrative. Hormuz drives energy inflation, the Fed hikes, risk assets break. Treasury shorts across the curve, VIX longs near the 100th percentile, Euro shorts at the 97th percentile. Every position is a bet on the same chain of events. Our stock Beaver positioning analysis as of July 7 shows 3 contracts flagged high risk for potential violent reversal. The 2-year Treasury at 45.8% short, Bitcoin at 58.4% short, and Palladium at 52.2% short. All 3 are crowded bets on the same macro thesis. If any link breaks, a diplomatic resolution at Hormuz, softer inflation data, or the Fed holding pat, these positions unwind together. The big money is positioned for inflation and rate hikes, but danger is building where the crowd is thickest. Now let's pull back and look at the bigger economic picture, what the Fed is doing, how jobs are holding up, and where the economy goes from here. Economy and the Fed. 3 numbers on this week's economic scoreboard capture the whole story. The trade deficit blew out to minus $77.6 billion in May, a 42% jump from April, and that kind of deterioration signals an economy consuming far more than it produces, which is exactly the imbalance that keeps the dollar strong and manufacturing under pressure. The VIX drifted down to 15, signaling broad market calm, but as we'll see, the internals tell a more fractured story underneath that placid headline. And the collective signal here is unmistakable. The economy is running warm, financial conditions remain easy, and that's the exact backdrop fueling Governor Waller's warning about potential rate hikes. The May trade deficit came in at minus $77.6 billion, blowing past estimates of minus $85 billion by nearly $21 billion. That kind of miss doesn't happen in a vacuum. It tells you the strong dollar is doing what a strong dollar does, making imports irresistibly cheap and American exports pricier abroad. The goods-only deficit ran even deeper at minus $105.8 billion, which matters because goods trade is where the dollar's bite is sharpest. Over the past year, the trade gap has widened about 16%, and with the Hormuz blockade threatening to push energy import costs higher, that trajectory is unlikely to reverse soon. This is the visible thumbprint of an economy that buys more than it makes. Average hourly earnings hit $37.64 in June, up 3.52% over the past year. Now, for a full-time worker, that's roughly $200 more per month, real money at the kitchen table. But here's why the Fed isn't celebrating. Wage growth at 3.5% still runs well above their 2% inflation target, and when paychecks grow faster than productivity, companies raise prices to protect margins. That wage-price feedback loop is the mechanical reason policymakers keep leaning toward tightening, even when the headline inflation numbers look like they're cooling. SOFR, the benchmark behind your adjustable mortgage and business loans, sits at 3.55%, ticking up slightly this week. The bank prime rate remains at 6.75%, which is the base your credit card APR and home equity line are tied to. So if you're carrying a balance, you're feeling this directly. But the structural signal here is the Fed's reverse repo facility, down to just $0.8 billion, essentially drained. What that means is the excess liquidity from the QE era has been fully absorbed. The cushion is gone. Any future liquidity stress has fewer shock absorbers to lean on, which is why Fed watchers are paying close attention to bank reserves at around $3.1 trillion. Financial conditions actually eased slightly this week. The Chicago Fed's index sits at minus 0.52, deep in negative territory, meaning credit flows freely. Risk appetite is very loose at minus 0.59 on the St. Louis gauge. And here's the paradox investors need to navigate. Conditions are this easy, yet the Fed is openly contemplating rate hikes. When markets are relaxed and the central bank is reaching for a bigger stick, that gap between loose financial conditions and a hawkish Fed is the central tension. It means policy transmission is broken, and the Fed may need to push harder to actually feel the effect. The Fed's balance sheet edged up to about $6.74 trillion as of July 8, rising about $11 billion on the week. Quantitative tightening has essentially stalled, and that stagnation matters because it means the Fed is no longer actively removing liquidity from the system. Treasury holdings grew roughly $10 billion, mostly in short-term bills, while MBS held flat at $1.95 trillion. That MBS number is the direct pressure behind mortgage rates staying elevated near 6.5%. Every week the Fed doesn't shrink that book, it keeps a ceiling on mortgage relief. Meanwhile, the Treasury's checking account dropped about 7% to roughly $749 billion as the government spends down its cash, which temporarily injects liquidity into markets. Think of it as fiscal stimulus by accident. The headline VIX fell to 15 this week. That's complacency territory. But the internals tell a story the headline buries. The Nasdaq 100 VIX sits at 25, roughly 10 points above the S&P, reflecting genuine anxiety in tech and semiconductors after this week's chip sell-off. A 10-point divergence between the broad market and tech is the kind of fracture you typically see right before a regime shift. It means smart money is hedging where the risk actually lives. The Economic Policy Uncertainty Index spiked to 374, up 115 points in a single week, driven by the Hormuz escalation and conflicting Fed signals. When uncertainty spikes that violently while the VIX falls, someone is asleep at the wheel. The latest CPI runs only through May, about 73 days old, showing prices up 4.17% year over year, and that staleness itself is a problem, because markets are trading on stale inflation data. Core PCE, the Fed's preferred gauge, sits at 130.8 also through May. But the leading indicator is what should grab you. Producer prices jumped 13% year over year in May. Producer prices lead consumer prices by roughly a month, so that PPI surge is tomorrow CPI pressure walking through the door. Meanwhile, the 10-year real yield sits at 2.32%, historically restrictive territory above the roughly 2% threshold that pressures gold and risk assets. That's why gold fell this week despite the geopolitical tension. Real rates above 2% are a stiff headwind, and when the front-end 2-year real rate is signaling the same thing, the long-run regime is tight. The unemployment rate dipped to 4.2%, and initial claims came in at 215,000. Both look healthy on the surface. But the June jobs report showed only 57,000 new positions against expectations of 110,000. That's a near 50% miss, and it signals that hiring has clearly slowed even as layoffs haven't spiked. Think of it this way. People who have jobs are keeping them, but the front door for new entrants is narrowing. Cyclical payrolls, the construction and manufacturing jobs that turned first, held flat at about 20.9 million, up just 0.7%. When the most economically sensitive sectors stop growing, that's the leading edge. Continuing claims at 1.81 million bear watching for any upward drift. That's where the next real signal lies. Existing home sales fell to 4.9 million annualized in June, down 2.4% from May and missing expectations of 4.2 million. With the 30-year mortgage at 6.49%, this market is effectively frozen. Buyers face punishing borrowing costs, sellers refuse to give up their locked-in low rates, and transaction volume grinds lower. That matters beyond real estate because housing is a massive engine of economic activity. Furniture, appliances, moving services, all the spending that follows a home purchase. May housing starts plunged 15% to about 1.18 million units, and even though that data is 2 months stale, the direction reinforces the freeze. Home prices are still holding with Case-Shiller up about 1.1% year over year, but price stickiness with collapsing turnover is not a healthy market, it's gridlock. FINRA's latest margin debt through May shows investors borrowed about $1.42 trillion on margin, up a striking 53.7% year over year. Here's why that number should make you sit up. Year-over-year growth above 30% has historically preceded major market tops, and we're now at 54%. The net credit balance sits at minus $992 billion, meaning investors collectively have borrowed well past their cash buffers. There's no cushion left. When leverage is this elevated, any sharp sell-off can trigger margin calls and forced selling in a vicious feedback loop, and that minus $992 billion figure tells you how little insulation there is. Paired with the calm VIX and loose financial conditions we saw earlier, this is the picture of a market that's complacent at the surface and leveraged underneath. For retirement investors, the message is simple. This is not the environment to be borrowing to invest. The bottom line: a warm economy, sticky wages, edgy inflation expectations, and heavy leverage layered on top of a market that feels calm. The Fed's rate hike threat isn't fading. And with bank earnings arriving tomorrow, J.P. Morgan, Goldman Sachs, Bank of America, and Wells Fargo all reporting Tuesday, corporate America gets the next word on whether this economy can keep defying gravity. Earnings pulse. 2 sectors made the cut this week. Industrials leads off, one beating EPS, guidance maintained, and the dominant tone is bullish. Then consumer defensive, a clean 3 for 3 on EPS beats, 2 of 3 holding guidance steady, but the tone across the entire group is cautious. Here's what stood out. The verdict across the industrial sector reads like this: pricing power isn't just a financial metric. It is the financial metric, and the gap between companies that have it and those that don't is widening every quarter. That thesis comes into sharp focus with Delta Air Lines, ticker DOL. Delta's management told investors the industry is recapturing fuel cost inflation at the fastest pace of any recent cycle. The numbers back that up. Revenue grew 14% year over year on barely 1% capacity growth. This was a pricing story, not a volume story. Total unit revenue jumped 12.4%. And critically, Delta affirmed its full-year EPS range of $6.50 to $7.50, despite a multi-billion-dollar fuel headwind. The stock still fell about 3.2% after the call, which tells you something about the market's mood, with oil surging on Strait of Hormuz tensions. Investors aren't rewarding fuel-exposed names, no matter how well they're managed. The sector dropped 3.26% on the week. What makes Delta's pricing power structural rather than cyclical is the competitive landscape. Ultra-low-cost carriers have slashed capacity by about 30% industry-wide, removing the downward pressure on fares that plagued airlines for years. On top of that, 61% of Delta's revenue now comes from premium cabins, loyalty, cargo, and maintenance, not basic coach seats. That diversification insulates the business from commodity pricing. The American Express remuneration alone is on track for $9 billion this year, up 10%. With only one major call this week, the industrial's red is narrow, but the signal is loud. Companies that control capacity and own premium demand are passing through inflation with room to spare. The pricing power verdict for consumer defensive is one of accelerating consolidation. Brands with scale are pulling ahead, but even the blue chips are being forced to buy volume with price cuts. All 3 companies on this slide beat both EPS and revenue estimates, yet every single one carries a cautious tone. The contrast worth watching is between General Mills, ticker GIS, the week's winner, and Constellation Brands, ticker STZ, the loser. General Mills gained 5.2% after its Q4 report, while Constellation fell 3.3%. General Mills management laid out a reality check. The company had to cut base prices to get under key thresholds after private label competitors stole share on affordability. Broad list pricing is effectively maxed out. Where pricing power still exists is in premium tiers. Cheerios Protein has grown into roughly a $100 million business, and the company priced above the core line to offset innovation costs. That selective pricing power, combined with $750 million in targeted cost savings for fiscal 2027, was enough to earn the stock a positive reaction. Constellation told a harder story. The new CEO maintained full-year beer guidance despite a first-quarter shipment beat, citing an abundance of caution. A spike in gasoline prices, up over 50% nationally during the quarter, dented beer demand, especially in Texas and Florida. Modelo Especial was described as sluggish. The stock dropped over 3%. PepsiCo, ticker PEP, sat in the middle. Management deliberately lowered prices on core U.S. snack brands to restore volume, and it worked, with salty snacks returning to positive volume growth and PepsiCo gaining share. But that's a concession of pricing power domestically. International told a stronger story, with 7% growth and a full percentage point of margin expansion. The stock slipped about 2.8%. The cross-sector signal this week is a widening divergence in pricing power. Delta demonstrated it in industrials, passing fuel inflation through with discipline. But in consumer defensive, even household names are cutting prices to hold shelf space. For retirement portfolios, the takeaway is straightforward. Pricing power is increasingly the dividing line between companies that can protect margins in an inflationary, tightening environment, and those that cannot. Now let's see how this lands on our top stock and ETF picks. Top stock picks. Starting with the buy signal radar, and here's something worth pausing on. There are currently 0 stocks flashing mechanical buy signals across our entire coverage universe. Now, before you tune out, that doesn't mean nothing is working. We've got a list full of momentum names and recovery plays putting up genuinely strong numbers. What it tells us is that our systematic trend filter, which requires a specific confluence of price action, trend strength, and directional confirmation, hasn't been fully triggered for any individual stock right now. Think of it like this. The runners are on the field and warming up, but the starting gun hasn't fired on a clean technical breakout. The VIX sits at 17.16, and in today's regular session the S&P 500 fell about 0.8%, while the Nasdaq dropped 1.6%, so we're working against a mildly negative market backdrop. In a neutral regime with no mechanical buy signals firing, the focus shifts to momentum persistence and identifying which stocks are building toward potential breakouts. Let's talk about what's hot right now, and it's a striking story. Energy is dominating the short-term leaderboards. The catalyst is clear from today's headlines. Renewed Middle East tensions are tightening refined product markets, pushing refining margins higher. Marathon Petroleum, ticker MPC, is up 10.4% over the past 7 days and nearly 18.3% over the past month, trading around $297. Valero Energy, ticker VLO, is right behind at 9.4% over 7 days and almost 20% over the past month, trading near $296. These are 2 of the largest independent refiners in the country, and when crack spreads widen, the profit margin between crude oil input and refined product output, their earnings power expands quickly. Both MPC and VLO show strong accelerating trends. And here's the remarkable part. This week's surge isn't a flash in the pan. Marathon is up nearly 80% year-to-date, and Valero is close behind at about 79%. That's powerful confluence, not just hot this week but delivering all year. Diamondback Energy, ticker FANG, joins the energy rally with a 10.3% weekly gain at around $192, though its longer-term trend is choppier with a flatter profile. FANG is a pure-play Permian Basin producer, so it benefits from rising crude prices differently than the refiners. EOG Resources, ticker EOG, is up about 8% this week at roughly $140, drawing attention as a premium oil producer that some analysts argue is trading at a discount, supported by cost reductions and strong free cash flow generation. On the tech hardware side, HP Inc., ticker HPQ, surged 9.6% this week to around $25. HP is catching attention as a high-yielding, undervalued tech stock, with analysts pointing to a nearly 5% dividend yield and bullish technical momentum. Hewlett-Packard Enterprise, ticker HPE, jumped 9.5% to about $47, riding the AI infrastructure wave. HPE just released its 11th annual Living Progress Report, highlighting how rising demand for compute-intensive AI workloads is placing greater pressure on energy and digital infrastructure, which is precisely the problem HPE sells solutions for. HPE is up over 95% year-to-date and more than 128% over the past year. Turning to the swing and recovery names, these are stocks that have been beaten down but are showing real signs of life. Adobe, ticker ADBE, is up about 6% this week and nearly 12% over 2 weeks, trading around $231. After roughly a 40% decline from peak levels, analysts are turning bullish, arguing that Adobe's fundamentals have actually improved even as the stock has pulled back. Shopify, ticker SHOP, gained nearly 4% this week to around $125 after Jefferies upgraded the stock to buy, citing strong early second quarter signals, a reworked partner program, and what they see as Shopify being built for the age of AI-driven commerce. PayPal, ticker PYPL, is up about 6% this week at roughly $48, continuing its steady recovery with an accelerating trend. Arthur J. Gallagher, ticker AJG, is worth highlighting at around $261, up about 21% over the past month. The insurance broker just acquired Med James to strengthen its specialty insurance platform, following another acquisition of Wilson M. Beck Insurance Services earlier this month. For retirement-focused investors, Gallagher represents the kind of steady compounder that grows through disciplined deal-making. Now for the big picture, the best 180-day performers, where the sustained winners live. Dell Technologies, ticker Dell, stands alone at the top with a perfect momentum score of 100. Dell is up an extraordinary 260% over 6 months and 234% year-to-date, trading around $427. The catalyst is well documented: partnerships with NVIDIA, AMD, and Microsoft in AI server and infrastructure manufacturing. After what Investors.com described as a shocking earnings beat, Dell rocketed higher and has barely looked back. For investors who remember the dot-com era, this is the picks and shovels play for the AI build-out. HPE ranks second on the 180-day list with a 114% 6-month gain, reinforcing the same AI infrastructure theme from a different angle. Texas Pacific Land, ticker TPL, is up about 37% year-to-date at around $409. TPL is a fascinating story because it started as an oil and gas land royalty company in the Permian Basin, but as reported today, West Texas is becoming a hub for AI data center development. So TPL is essentially a real estate play on the AI boom with energy royalties underneath as a floor. Thomson Reuters, ticker TRI, rallied 7.3% this week to about $94, as the company aggressively deploys artificial intelligence across its content and technology businesses, while streamlining engineering operations to improve efficiency. The standout pattern across all these names is sector concentration. Energy and AI infrastructure are the twin engines driving the strongest performers. Refiners like MPC and VLO benefit from geopolitical supply concerns that widen their profit margins. Companies like Dell and HPE are riding the AI capital expenditure cycle, supplying the physical hardware that makes AI possible. A quick smart money side note before we move on. Across our picks today, FINRA short interest data doesn't flag any extreme positioning in either direction. We're not seeing aggressive short builds or notable covering squeezes among these specific tickers. That's actually a constructive signal. When shorts are relatively quiet, it means the bullish moves aren't being actively faded by sophisticated bearish traders. The trends we're seeing appear genuine, not artificially inflated by short covering dynamics. The bottom line for today: with no mechanical buy signals flashing and the broader market in a neutral regime, patience and selectivity matter. The energy and AI infrastructure themes remain the strongest fundamental narratives, and the stocks riding those waves, particularly MPC, VLO, Dell, and HPE, are the ones worth monitoring for potential entry points as their trends continue developing. Top ETF picks. The ETF buy signal radar is quiet today. There are no leveraged ETFs currently flashing active buy signals. That doesn't mean nothing is happening in the markets. It means our systematic trend-confirming system isn't giving the green light on leveraged products right now. Sometimes patience is the trade. A reminder about leveraged ETFs generally. These funds use derivatives to amplify both returns and losses. They're for short-term trading only and decay if held long-term. Keep positions small and have an exit plan. These are short-term trading vehicles, not something to buy and hold in a retirement account or with money you're counting on. What's hot this week is all about energy. President Trump has announced a blockade and tolls on the Strait of Hormuz. The U.S. has renewed military strikes against Iran, and according to the New York Post, oil has risen to nearly $80 a barrel. For anyone who remembers the 1970s oil shocks, this is a familiar pattern. Geopolitical risk in the Gulf translates directly into energy prices. Leading the charge is NRGU, the microsector's U.S. Big Oil 3X leveraged ETN, up 28.9% over 7 days and 104.6% year-to-date. WTIU, the microsector's Energy 3X leveraged ETN, gained 24.4% this week. OILU, tracking oil and gas exploration companies at 3X leverage, rose 21.7%. And UCO, the ProShares Ultra Crude Oil Fund at 2X leverage, climbed 18.3% over 7 days and has more than doubled year-to-date with a 101% gain. MarketWatch reported today that U.S. strategic petroleum reserves are precariously low and have been hit by equipment failures, another factor squeezing supply. ERX and DIG, the Direction and ProShares 2X energy funds, each rose about 13% this week, confirming this is a broad energy rally, not a single product story. Now shifting to the year-to-date leaders, where the story moves from oil to technology. DLLL, the GraniteShares 2X Long-Del Daily ETF, is the clear standout, up 717.7% year-to-date and 846.5% over 6 months. That's the AI infrastructure build-out trade in its purest, most amplified form. CSCL, the Direction 2X Cisco Bull ETF, has gained 117.2% year-to-date as Cisco benefits from data center expansion. CNCG, the 2X Long Centene ETF, has climbed 115.2% this year, a healthcare story reflecting defensive rotation. In the swing and recovery category, CRWL, the 2X Long CrowdStrike Fund, has delivered 113.1% year-to-date despite pulling back 12.1% this week. OKTG, the 2X Long Octa ETF, shows a similar pattern, up 104.7% year-to-date but down 12.8% recently. Both are cybersecurity names that ran hard and are now digesting gains. FIGG, the 2X Long Fig Fund, surged 23.7% this week with strong recovery momentum. METU, the Direction Daily Meta Bull 2X ETF, gained 18.6% this week after a rough stretch. It's still down 37.3% over the past year, so this represents early recovery rather than a confirmed trend. On the leveraged technical side, several funds show golden cross formations with bullish MACD crossovers. UCO stands out with strong statistical backing. PIL, the Direction Daily Pharmaceutical and Medical Bull 3X ETF, is up 35% over the past month and 205.9% over the past year. That's the defensive healthcare bid finding its footing. GGLL, the 2X Long Google ETF, has pulled back nearly 8% this week into what technicians would call a buy zone, with an RSI reading around 42. For listeners who prefer something without leverage, consider NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. It holds companies that have raised dividends for at least 25 consecutive years. As a recent article put it, it's built for one job, delivering a slowly rising income stream. That's the kind of holding that belongs in a retirement account, unlike the leveraged products we've been discussing. Now let's look beneath the surface at smart money positioning. The latest FINRA short volume data shows IWML, EMDV, ZMUN, and QULL all sitting at or near 100% short volume. But here's the important context. Most short volume in leveraged ETFs is simply intraday market maker plumbing, firms hedging order flows throughout the trading session. The real signal lives in the extremes, and in whether any of those names overlap with our highlighted picks. Today, none of those high short volume tickers appear on our list, which means the short interest picture is relatively clean for the energy and tech trends we just covered. Looking at hedger activity specifically across our leveraged picks, short volume levels are broadly within their normal ranges. There are no major shorting spikes or notable short covering signals this week among the ETFs we highlighted. In plain terms, big money isn't positioning aggressively against these trades, but it isn't piling in with unusual conviction either. The technical setups stand on their own. The smart money flow simply isn't contradicting them today. Options activity and setups. Now let's flip to the options market. First, what the broader tape is telling us about fear and dealer positioning. Then we'll bring that read back down to the individual stocks on today's pick list. The aggregate put-call ratio across the 3 major index ETFs sits at about 1.9 today. Let me translate that. Calls are bets that a stock or index goes up. Puts are bets it goes down, or insurance against a drop. A put-call ratio above 1 means traders bought more puts than calls, more downside protection than upside speculation. At 1.9, that's a cautious but not panicked read. We saw this across the board. SPY at 1.12, QQQ at 1.2, and IWM, the small cap ETF, at 1.16. Nobody's in full fear mode, but the bias is clearly toward protection. Now the SPY 25 Delta skew, which is essentially the cost of crash insurance versus lottery tickets. A 25 Delta skew measures how much more traders are paying for out-of-the-money put protection guarding against a sharp drop versus out-of-the-money call speculation, which bets on a sharp rally. Today that skew reads just 3.37 points. That's low. Crash insurance is dirt cheap right now, barely more expensive than an upside bet. So here's the tension worth noting. The put-call ratio says cautious, but the skew says calm. Traders are buying slightly more puts than calls, but they're not willing to pay up for the deep, out-of-the-money protection that signals real fear. Mixed signals hedging, not panicking. Now to the market makers, the dealers who sell us these options. Their hedging either calms the tape or amplifies it. We measure this through gamma exposure, or GEX. Think of positive gamma as a shock absorber. Dealers buy dips and sell rallies, which dampens volatility and pins prices in a range. Negative gamma is the opposite, an amplifier. Dealers sell into weakness and buy into strength, making every move sharper and faster. SPY is sitting in negative gamma territory right now, total net gamma of about minus 1742. Spot is at $749.17, and the gamma flip, the level where dealer behavior switches from shock absorber to amplifier, sits at $754.79. SPY is trading below that flip, which means the amplifier is on. If the index slips further, dealers are forced to sell, accelerating the move. Max Pain sits at $750, almost exactly where we are, that can act as a magnet pulling price toward it into expiration. QQQ tells a very different story. It's in positive gamma, about plus 44.32, with spot at $711.74, well above the flip at $686.83. That puts tech in dampener mode. Dealers are buying dips and selling rips, which should keep QQQ range-bound. Max Pain at $717.50 is close to current price, another magnet. IWM, the small-cap ETF, is the most amplified of the three. Net gamma of about minus 54.76, with spot at $281.98 sitting well below the flip at $289.3. Small caps are in full amplifier zone. The risk picture today diverges. Large cap SPY and small cap IWM are both below their flips with amplifiers running, while QQQ sits in the calm zone. That divergence matters. The volatility risk is concentrated outside of megacap tech. Now let's look at sector volatility. We're comparing implied volatility, the market's forecast of how wild a sector ETF will swing, against realized volatility, which is how wild it actually has been over the past 30 days. When implied runs well above realized, options are pricing in more drama than reality. Somebody's bracing for something. Energy is the richest sector on the board. XLE has an IV/HV ratio of 1.22. Options are priced as if the energy sector will move about 22% more than it actually has. That lines up with the oil disruption headlines and the Strait of Hormuz crisis. Materials and communications are close behind, both near 1.20. Traders are paying up for protection in commodity-linked and supply chain-sensitive sectors. On the cheap side, consumer staples, XLP, stands alone with a ratio of 0.80. Options there are priced for less drama than the sector has delivered. Semiconductors sit at 0.86, meaning after the recent chip sell-off, actual volatility has outrun what options are pricing. That's either complacency or a bet that the worst turbulence is behind us. Technology overall is at 0.93, and healthcare at 0.94, both running below their recent realized moves. Let me pull a few names from the unusual options flow scanner. Oracle, ticker ORCL, shows massive bullish activity. About 84,900 contracts changed hands with a put-call ratio of 0.9. That means for every put traded, roughly 11 calls changed hands. Volume was about 85% of standing open interest, so this is fresh positioning, not routine roll activity. No cross-segment confluence today, but the options tape is unambiguous. Meta shows a similar pattern, volume of about 34,800 contracts, PCR of 0.31, tagged with high volume to open interest and bullish skew. Again, fresh bullish positioning. The two names with cross-segment confluence are Amphenol, ticker APH, and HP, ticker HPQ. APH carries a bullish option skew with a PCR of 0.11, overwhelmingly call-driven, and it also showed up in our house trading section. That's the kind of confirmation we look for. The options market and Congressional Trading leaning the same direction. HPQ appears in our momentum picks and carries a bullish option skew with a PCR of 0.17. When a stock hits both the momentum screen and the options flow scanner, that's double confluence worth noting. Now let's bring that backdrop down to our picks. We pre-filtered the pick list for names where options activity argues for higher prices, either through a strict gamma squeeze setup or through a clear bullish positioning bias. Only one name cleared that bar today. The scorecard shows only the picks where options activity leans bullish. Neutral and bearish names were dropped upstream. Each row carries a squeeze phase label. Pre-fire means a coiled spring ready to go. Mid-fire means the amplifier is on. Late means the move is mature. And long gamma means dealers are running a dampener, no squeeze machinery at all. Today we have exactly one name, Humana, ticker HUM, and it sits squarely in the long gamma category, a suppressive dampener regime. So this isn't about an explosive setup. It's about a stock where dealer hedging is working in favor of stability and where the positioning tilt underneath is nonetheless bullish. Let me explain the gamma squeeze checklist. A real squeeze setup needs 4 things at once. The stock trading below the gamma flip so the amplifier is switched on, gamma exposure actually negative, a call wall 3 to 15% above for runway, and a put wall in the same range below for a floor. When all 4 align, dealers are forced to buy as the stock rises, feeding the move higher. Humana doesn't pass that strict checklist. It's above the gamma flip spot at $406 versus a flip at $368.57, which puts it firmly in the long gamma dampener regime. The squeeze machinery isn't running, but here's why it still made the cut. Positioning leans bullish anyway. The upside score is 31 versus a downside score of about 3. That's roughly a 10-to-1 ratio favoring higher prices from a positioning standpoint. Different reason than a squeeze, same direction. The put-call ratio on open interest is 0.77, more calls outstanding than puts. Volume PCR is even lower at 0.63, and the call skew reads negative at minus 9.1%, meaning upside calls are actually being bid for. That's unusual, and it's a quietly bullish tell. Humana at $406. Dealers are in dampener mode. The gamma flip sits at $368.57, and spot is comfortably above it. That means dealers are buying dips and selling rallies, which should keep the stock range-bound rather than prone to sharp swings. The call wall sits at $420, about 3.4% above current price. That's where dealer hedging would create resistance and slow any rally. The put wall is at $380, roughly 6.4% below. That's where dip buyers tend to show up. Max pain sits much lower at $365. One important calendar note. Earnings land on July 29, 16 days from now. That's a reset event. Everything about this positioning read matters only between today and that earnings date. After earnings, the options board reprices from scratch. Diving deeper into Humana's positioning card, one metric jumps off the page, the IV/HV ratio of 1.57. Implied volatility is 60.5%, but realized volatility over the past 30 days is only 38.5%. Options are pricing in dramatically more movement than the stock has actually delivered. When premium is that rich, the math favors selling options rather than buying them. Think of it like selling hurricane insurance in a season where everyone's willing to overpay for coverage. You collect the inflated premium. The second metric worth teaching is charm, specifically, negative charm of about minus $1.25 million per day. Charm tracks how dealer hedging shifts as time passes toward expiration. Negative charm means dealers are slowly selling the underlying stock each day as options decay. Think of it as a gentle but steady headwind, roughly $1.25 million in selling pressure daily. Not dramatic, but it's a quiet drag on the stock between now and earnings. And Vanna exposure is modest, about $255,000. Vanna measures how dealer hedging shifts when implied volatility changes. At this modest level, even a volatility spike wouldn't force much dealer rehedging. There's no hidden bid waiting to emerge from a volatility shock. What you see is what you get, a calm, range-bound setup with a bullish positioning tilt, an earnings catalyst approaching in about 2 weeks, and rich premium that rewards sellers over buyers. Remember, this entire segment is positioning context, not a trade idea. A picks list with a structural tailwind underneath it is a higher quality setup than one without. That's the only claim. With that backdrop locked in, let's see what Congress was doing this week. Congressional Trading. New disclosures just landed this afternoon. In the Senate, Arkansas Senator John Boozman filed 8 trades buying United Health Group, UNH, Constellation Energy CEG, the iShares Expanded Tech Software ETF IGV, the Schwab Tips ETF SCHP, and a Palladium ETF, while selling a pipeline fund, a Commodities ETF, and Atmos Energy, ATO. In the House, Washington's Rick Larson bought McKesson, MCK, and Amphenol, APH, while selling S&P Global SBGI and Abbott Labs, ABT. And Tennessee's Chuck Fleshman purchased Zodis, ZTS. a stock facing multiple class action lawsuits filed just today. The real signal this week is cluster activity in the House. Two members each bought McKesson, Abbott Labs, and Home Depot. That kind of multi-member buying is worth noting. On the sell side, two members unloaded BlackRock, and here's the interesting divergence. Two House members sold United Health Group, even as Senator Boozman was buying it across the Capitol. Both chambers lean net bullish over the past 30 days. The Senate logged 58 trades with a slight buy edge. The House reported 241 trades, 149 buys against 92 sells. The House's most accumulated name was Hubbell, HUBB, with 6 buys, while Microsoft, MSFT, saw the heaviest selling, with 3 members trimming. With big bank earnings starting tomorrow, watch whether Goldman Sachs, quietly bought by Senate members, justifies that conviction. Insider activity. The single strongest insider signal over the past 2 weeks comes from Simon Property Group, ticker SPG. 11 insiders at the mall REIT bought shares, 28 separate purchases totaling about $533,000, with 0 insider sells on the tape. When nearly a dozen executives at the same company are buying with their own money and none are selling, that's conviction worth paying attention to, especially at a stock yielding over 4% that's already up more than 21% this year. The broader insider mood, though, is heavily tilted the other way. The buy-to-sell ratio over the last 14 days sits at just 0.3, roughly 30 sells for every buy. That's subdued by any measure, though much of it reflects routine diversification rather than alarm. The selling is concentrated almost entirely in AI infrastructure names. A single insider at Rocket Lab, ticker RKLB, unloaded roughly $286 million in shares following its $8 billion Iridium acquisition. 6 insiders at Dell sold about $211 million, and 9 insiders at CoreWeave cashed out nearly $130 million as Meta's new cloud business plan stirred competitive fears. Here's the key distinction for retirement investors. Insider selling is noisy. It can be taxes, estate planning, or deal-related. But when multiple insiders buy the same stock simultaneously, as they're doing at SPG, that's the signal that cuts through the noise. Federal budget. Through July 10th, the federal government ran a $197 billion deficit this month, about $24 billion worse than the same period last July. That widening gap matters because it means the structural imbalance isn't stabilizing. Spending is outrunning revenue by more each year. Gross receipts came in near $121 billion, and after $3.2 billion in refunds, the government had roughly $118 billion to fund operations. But here's what's revealing about priorities. Interest on the debt is now costing more each month than the entire Defense Department. Before a single dollar goes to the military, we've already paid bondholders more. On a single day, Medicaid grants to states alone consumed $3.7 billion, a reminder of how quickly mandatory spending compounds. Zoom out to the full fiscal year. Through July 10th, the government has collected $4.58 trillion and spent $5.80 trillion, a $1.22 trillion gap that's about 6% better than last year. But better is relative. At this pace, we're still on track for a $1.82 trillion full-year deficit. The improvement isn't because spending came down, it's because receipts ticked up. The spending trajectory hasn't bent. The decade view reveals the deeper problem. Outlays jumped during COVID and never returned to baseline. We normalized a wartime spending level in peacetime. Nowhere is that clearer than interest costs, climbing from $1.15 trillion in 2024 to $1.27 trillion last year, to a projected $1.39 trillion this year. Each year, a bigger slice of your tax dollars flows to bondholders instead of services. That trajectory, interest growing faster than the economy itself, should worry people most. The national debt stands at $39.4 trillion. To make that real, roughly $118,000 for every citizen and $263,000 per taxpayer. The pace is accelerating. The most recent trillion took just 4.8 months, and each milestone arrives faster than the last. Compounding is overtaking organic economic growth. At this trajectory, $50 trillion arrives by roughly mid-2029. Against the economy, debt to GDP sits at 122%, well beyond the 100% threshold economists historically associate with fiscal stress and slower long-term growth. And in a rare twist, the debt actually ticked down $1 billion on July 10th. That almost never happens, don't get used to it. Over the past year, it grew by more than $3.2 trillion. So who owns all this debt? Private domestic investors hold the largest share at roughly 69%, foreign investors about 24%. Japan still leads foreign holders at $1.21 trillion, but China has been steadily reducing, now third at $651 billion, behind the UK's $937 billion. Beijing is quietly de-risking its exposure to U.S. fiscal policy. The deeper story is the rate environment. The average interest rate on marketable debt has climbed from 2.87% in mid-2023 to 3.41% today. That doesn't sound dramatic until you apply it across $31 trillion in marketable debt, which is precisely why the annual interest bill now exceeds the entire defense budget. But here's the trap beneath that. About $7.4 trillion, nearly a quarter of all marketable debt, reprices within 12 months. Every 25 basis point increase adds $18.5 billion in annual interest. A full point adds $74 billion straight to the deficit, which adds to the debt, which requires more borrowing at those higher rates. The government has essentially financed itself with an adjustable rate mortgage on a national scale. That worked when rates were zero. It doesn't now. The longer rates stay elevated, the more of that cheap legacy debt rolls into today's costs, a feedback loop feeding on itself. Week ahead. This is a massive week for earnings, with Wall Street's biggest banks kicking things off on Tuesday, July 14. JP Morgan Chase ticker JPM, Bank of America BAC, Wells Fargo WFC, Goldman Sachs GS, and Citigroup C all report before the opening bell. Banks are the economy's pulse. Their trading revenue, loan growth, and deposit costs tell you whether businesses are borrowing and consumers are spending. Fastenal Fast, a key industrial distributor, reports the same morning, offering an early read on manufacturing supply chains. Wednesday brings more financials: Morgan Stanley, MS, BlackRock, BLK, PNC Financial, PNC, alongside Johnson & Johnson, J&J, a dividend stalwart that millions of retirees hold. United Airlines, UAL, reports too, a window into consumer travel spending. And ASML Holding, ASML, the Dutch semiconductor equipment leader, is always worth watching given the AI chip backdrop. Thursday shifts the spotlight. Netflix NFLX reports, with subscriber growth and advertising revenue under scrutiny. United Health Group, UNH, and GE Aerospace, GE, both deliver results barometers for healthcare costs and aviation demand. Abbott Laboratories, ABT, and Intuitive Surgical, ISRG, round out a healthcare-heavy day. Friday wraps up with regional banks Fifth Third FITB, Regions RF, Truist TFC, plus Travelers TRV for an insurance read. Now to the economic data, and Tuesday is where it starts. The June inflation report lands at 12:30 Eastern. Headline CPI is expected to cool from 4.2% to about 3.8% year over year, with core holding at 2.9%. With Fed tightening talks swirling, this number carries enormous weight for anyone watching their bond yields or mortgage rates. Thursday brings June retail sales, forecast to slow sharply from the prior 0.9% gain to roughly 0.2%, plus initial jobless claims and speeches from Fed officials Jefferson and Logan. Friday is packed. Housing starts, building permits, industrial production, and the University of Michigan Consumer Sentiment Survey. That prior sentiment reading of 49.5 was strikingly low, so any improvement matters. On the IPO front, two operating companies debut Thursday. Standard Nuclear, ticker STDN, a nuclear fuel producer based in Oak Ridge, Tennessee, targets a valuation of up to $3.55 billion, pricing shares between $18 and $21. And C-Square, CSQR, a Brookfield-backed data center provider, seeks a valuation up to $4.18 billion, riding the AI infrastructure wave. It's a packed week that could set the market's direction for the rest of summer. I'll be here every step of the way as the numbers roll in. As we near the end of the podcast, the key takeaways are: the single most important thing to remember is that professional money has piled into the same trade across every asset class, betting on rate hikes and risk breaking. When everyone's positioned the same way, one surprise forces them all to exit together. Tomorrow's CPI report and big bank earnings are your first test of whether that crowded thesis holds or cracks. Head to stockbeaver.com for the interactive charts behind everything we covered today. Thanks for listening. I'll see you tomorrow.